Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from Voyageur Mutual Funds, and let me tell you, there's a lot more than meets the eye. Are these guys sailing smoothly, or are they just rearranging the deck chairs on the Titanic? Let's find out. First off, we've got the official stuff. Voyageur Mutual Funds just dropped their semi-annual report, which is basically like a report card to their shareholders showing how the money's being managed. It covers everything from which bonds they're buying to how much it all costs. This is a certified shareholder report, basically a way for the company to present important information about the funds to shareholders. It is not as comprehensive as a 10K 10Q, but still insightful. This particular report covers the period up to February 28, 2025. Now, this report includes a bunch of smaller reports, each focusing on a specific fund within the Voyageur family, so we'll jump between them. Let's start with the Macquarie Minnesota High Yield Municipal Bond Fund, formerly known as the Delaware Minnesota High Yield Municipal Bond Fund. This fund focuses on Minnesota municipal bonds that are considered high yield, meaning they carry a bit more risk but potentially higher returns. Keep an eye on that, formerly Delaware. Things changed after December 30, 2024. Here's a question you to invest in this fund. We can see from the text on costs of a $10,000 investment. For Class A shares, the costs come out to $42 per dollars invested, a percentage of 0.84%. And here's some interesting points about that fund as of February 28, 2025. Net assets totaled about $238 million, with a portfolio containing 232 holdings. The advisory fees paid out totaled $461,000, a portfolio turnover rate, which indicates how frequently the fund buys and sells its investments, was a very low 3%, so not that much turnover. Where exactly is this fund's money? If we scroll to sector allocation, we can see the composition. A pretty big chunk, 38.70%, was in healthcare revenue bonds. Another large chunk, 27.35%, went into education revenue bonds, and 10.33% in local general obligation bonds. The money is being used almost entirely in one state, Minnesota. We see the table with state and territory allocation, where 94.33% is in Minnesota compared to 4.41% in Puerto Rico. Moving on, the Macquarie National High Yield Municipal Bond Fund. See that name change though? These were formerly Delaware National High Yield Municipal Bond Fund. The national in the name means this fund isn't limited to just one state. Looking at the cost for Class A shares in this fund, we're seeing that $42 cost for a $10,000 investment, same as before, with a very similar cost percentage of 0.85%. It's a lot bigger at $3.7 billion. In fact, if we look at total holdings, they are at 832, with advisory fees about $8 million. The percentage turnover is again relatively low at 5%. Looking at the sector allocation, and we see industrial development revenue pollution control revenue bonds at 22.36% and education revenue bonds at 24.4%. It's pretty spread out from there. The fund's holdings are all over the place. Instead of all in one state, it's 13% Puerto Rico and then 12.40 in California, also 10% in New York. That completes the double-digit values. Axed in comparison to the last fund, which was almost all in Minnesota. Third fund is the Macquarie Tax-Free California Fund. Let's check it out. And again, for Class A shares, the costs come out to $40 per $10,000 invested, an expense ratio of 0.81%. This one is a fairly modest $321 million in total net assets, has 245 holdings and paid about $0.59 million in advisor fees. Portfolio turnover is slightly higher again at 6%. The top allocation is in education revenue bonds at 18.44% and then a bit lower to healthcare revenue bonds at 14.62%. They are pretty close though. What about region? This is tax-free California fund, so let's see. There we go. 85.4% is in California, so it's a real concentration. And now the tax-free Idaho fund. Let's take a peek. Same old question. The costs here are $43 for a hypothetical $10,000 investment. This fund has only 116 holdings for a total of 137 million and 2046K in advisor fees. What about turnover? That's actually the highest we have seen so far at 8%. Looking at the tables, we see that this is pretty well spread out between special tax revenue bonds and education revenue bonds for 21% each. And now for where the allocations of investment are, we see 81% in Idaho. So again, similar to the last California fund, with the fund focusing on its home area. We can also see that some of it is in Puerto Rico. The second last fund in this report, time to talk about the Macquarie Tax-Free New York Fund. Class A costs are at $40 or about 0.41%, same numbers as other funds. This fund has roughly 300 million and 970 holdings and 565k for advisor fees, a relatively lower turnover of 6%. We see that special tax revenue bonds are the main focus at about 25%, with education revenue bonds at 15% and transportation bonds at 14% afterwards. And just like before, the majority, 84% of this fund is indeed in New York, 12% in Puerto Rico. Seems to be a running trend for these tax-free funds. Macquarie Tax-Free Pennsylvania Fund, the last fund, let's wrap this up. And Class A costs are at $40. The fund is at about 438 million, has lower advisor fees, lower number of holdings. Now for the sector allocation table. It's all over the place, but the top value is healthcare at roughly 30%. What about allocations? Just as expected, 90% of this is on the state of Pennsylvania. At this point, this should not be unexpected. So what does all this mean? Here is my take. These funds, while presenting an okay picture of management, are highly concentrated in specific states. While this allows you as an investor to take state tax breaks, it will leave you extremely vulnerable to any negative changes in the state economy. Furthermore, the investments in Puerto Rico and potentially in other US territories present increased risk. The financials point to reliance on the performance of those regions. Despite touting good expense ratios, we see that some of them are in broken industries specifically related to tobacco. This could mean that these funds invested too heavily into legacy cash flows with no growth opportunity. For a person looking for some tax-advantaged financial vehicles and comfortable to bet on a specific state or territory, this can work. There are both better and worse investment options, so do your own research. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, be sure to hit that like button, drop a comment with your thoughts, and subscribe for more financial deep dives. Until next time.